Welcome everyone to today's webinar, Empowering Certainty with Sound Planning. This is the last of our three-part series of a look ahead, post-election insights from NFP experts. Thank you all so much for joining us. Before we begin, I want to take a moment to let you know that we are recording this session, and the recording will be both distributed to attendees via email, as well as available through our normal communication channels. As you have questions, you may post them in the Zoom Q&A located at the bottom of your screen, and we will address questions at the end of the call. If we are unable to address your question today, please email learning@nfp.com and it will be routed to the appropriate party. At this time, I'd like to introduce our moderator for today's webinar, Mike James, Head of Individual Solutions and President of NFP Life Solutions. Mike, the floor is yours.
Thank you, and good morning, everyone. Welcome to our latest installment of a client series, and we are so excited to have you all with us. I'm going to make some opening comments and some housekeeping before we get going, but I'd be remiss if I didn't just say I hope everyone is safe and secure where you are. 2020 has certainly given us lots to think about, lots to be thankful for, and lots to focus on. It's probably not lost on anyone in this audience that we've all had to reprioritize our lives. We've had a heightened awareness around the things that really, really matter. And for us at NFP, it's no different. We have found great alignment with our clients every step of the way since the first quarter of 2020. We have walked side by side with every client across every business segment. So I'm thankful for this last installment of a three-part client series this week. It started out with Admiral Stavridis, and I have to say the Admiral was eloquent in helping us appreciate what's happening on the world stage, helping us understand where our focus should be as a society, and also helping us understand how things are changing so rapidly. I'm thankful for him. I'm thankful for our relationship with him and him leading us at the board level with our executive management team. I also want to let you know that the leadership group at NFP has never been stronger. I'm so proud to be a part of a diverse, caring, loving group of professionals who have a moral compass that shines bright every single day, and no greater than this year of 2020. With that said, I'd like to get started. I'd like to share with you the agenda for the call today. Again, I'm going to give you some opening remarks here. I'll get into the housekeeping in a second, but I'm really excited. Some of our leaders from across the company and the industry are going to help us appreciate where we are as an organization, where we are in society, how the macro environment is going to affect our ability to deliver solutions to you. Mike LaMena, who heads our Wealthspire Advisors organization, is going to start out with a high-level macro view on the market, the economy, and things we need to be aware of. His partner and managing director, Mike Delgass, will dive a little bit deeper into current developments and strategies that we think you need to be aware of. And finally, Kristin Bulat, who heads our advanced sales department in the life insurance division, and Armstrong Robinson, who's the chief advocacy officer at our industry's association, Finseca, will talk about the excitement and the awareness coming out of a general election that will seed a new administration looking ahead. Okay, so a little bit of housekeeping before I get into my slide. The Q&A function at the bottom of the screen is there, and you're welcome to load up a question or two at your leisure if something jogs your memory or you want a little bit of a deeper dive on a subject. And at the end of each segment, I'll try my best to categorize those questions and put them to the subject matter experts at hand. Well, if I didn't start out with a little bit of an overview on NFP, I think we would miss the mark. I started out by saying I'm so proud to be a part of this team. With close to 6,000 employees worldwide, 1.5 billion in gross revenues, and offices represented, 45 offices represented internationally between Canada and Europe is amazing. I've been with the company close to 15 years, so I've seen us evolve into what is a proud insurance brokerage and consulting business that's on the worldwide stage. I'd like to give you a little bit about our structure. And this is where the real excitement happens. So behind the curtains, I know clients enjoy our advisors and our leaders leaning into advice and solutions that are tailor fit for you. But there is a method to the madness at the organization and how we all work together to bring those solutions to you. The company is broken into 3 vertical business segments. One dedicated to corporate benefits, that's our retirement, health and welfare, and executive benefits. Property and casualty, which is both commercial and personal lines, and then individual solutions, which houses our wealth management and our life insurance businesses. And the 4th leg of the stool, which is a horizontal leg of the stool, is where innovation lives. We live in an environment where data and data management and the ability to normalize it so that you can use it to influence your business is top of mind everywhere. And I'm really proud that the company has built this other leg of the stool because it allows us all to leverage and scale up right inside the company and to make sure that we're communicating as efficiently as possible and ultimately bringing those strategies to each of you. With that said, I'd like to just pay a little bit of respect to the business leaders in this business segment. We've got some of the greatest minds, leaders, and advisors across wealth management and life insurance. We have branded businesses under the NFP brand, and we have specialty brands that represent the legacy of those individual businesses that we thought and respect that should be present. Lennox Advisors or Lennox Wealth, DeMayo Schneider, and Wealthspire are prevailing brands in our wealth management business, alongside NFP branded wealth management experts that give us now in excess of 90 billion of an AUM footprint. I'm really proud of that because we now get to reach clients in highly specialized ways and to leverage our capabilities across the platform. And for life insurance, we have both retail and wholesale businesses that now collaborate. They're aligned both strategically and tactically on a daily basis to deliver solutions to you at the highest level when you need it. So I'm thankful for each business leader, each business segment underneath the division, and I'm happy that we're all working collaboratively together. With that said, I'd like to now move on to getting into the meat of this presentation. I'd like to turn the presentation over to Mike LaMena and Mike Delgass. They're going to take us through the world of wealth management and some of the things we need to know. Mike and Mike.
Great. Thank you, Mike. Thanks for having us on today's call. 2020 certainly has been an unprecedented year on a historic scale. When you evaluate the global disruption caused by the COVID-19 pandemic, as measured both in very real human impact and in economic terms, and couple it with the uncertainty we experienced in the latest political election cycle, it seems the only certainty in 2020 has been uncertainty. So with uncertainty as the norm, how best can individuals navigate the future? At Wealthspire, we believe that the best approach for clients to tackle and deal with ongoing uncertainty is to be crystal clear on their goals and objectives. Gaining clarity on what you want to achieve by digging deep into your hopes, dreams, fears, aspirations, and then engaging in a robust goal-based planning process is crucial to long-term success. Mike, as you indicated, 2020 has caused a lot of people to reevaluate many things in their lives, and being clear on what you want to achieve, what's important to you, and then translating that into a long-term financial plan is crucial to navigating the kind of volatility we experienced this year, whether that be the drawdown at the end of Q1, the rapid bounce back in Q2, market highs that we've recently hit. All of that volatility, if you didn't have a disciplined plan focused on your long-term objectives, very difficult to stay the course and be grounded in long-term objectives. So having a plan and engaging in ongoing planning discussions with expert planners really enable clients to stay grounded among uncertainty and focused despite being bombarded by noise and headlines that are constantly selling the latest narrative. So planning is the foundation that provides a signal in the noise that empowers individuals to move forward with clarity and confidence. Wealthspire has over 50 certified financial planners, CFPs, who are experts in collaborating with clients to design and execute on customized long-term financial plans. Before we get into some of the specifics around how clients can best engage in financial planning activities that will help them achieve their long-term goals and aspirations, I'll take just a couple of minutes to provide a little more context on Wealthspire as an organization. Then I'll turn things over, as Mike James indicated, to my colleague, Mike Delgass, who's a talented senior financial advisor at Wealthspire, who works closely with a number of high net worth and ultra high net worth families, including many relationships with complex multi-generational estate planning needs, ultimately focused on helping those families achieve their goals. So Wealthspire is a registered investment advisory business focused on serving high net worth and ultra high net worth individuals in a fiduciary capacity. We don't have proprietary products or economic conflicts of interest like product sales and incentives. We are true fiduciaries focused on always acting in the best interest of our clients. We have over 150 team members across 14 locations throughout the U.S. We manage over $12 billion in assets on behalf of those clients, north of 4,500 high net worth and ultra high net worth households, clients ranging from a few $100,000 to clients with hundreds of millions of dollars. We take great pride in having a client retention rate for the last 12 months during a period of extreme volatility of 99%. That speaks to the passion and commitment that our team brings to serving our clients. Mike, if we can move to the next slide. In terms of our approach, we are first and foremost planners. Through a collaborative and consultative process, we work with clients to really understand their goals, not just financial goals, but life goals. Ultimately, life goals intersect with financials, but we get personal. We truly want to know what matters to our clients and then create personalized and tailored plans that are unique to every relationship. We believe when goals are clear and we're ready to put a thoughtful design plan into action, you need to invest for the long term. When you look at the volatility we experienced this year, if you didn't have a long-term horizon, it was easy to be swayed by the gyrations of the market. Being grounded in long-term investment objectives really helps you be successful over the long haul. We use the latest tools and modeling capabilities. We leverage a diverse mix of asset classes and investment strategies, ultimately to build portfolios that seek to meet a client's specific desired goals without taking undue risk. At the heart of our work is a passion to serve our clients and simplify their lives by being their trusted financial quarterback. We provide comprehensive guidance across a full range of planning services, including general financial planning, charitable giving, special needs planning, trust and estate planning, liability assessment. Ultimately, we want to simplify our clients' lives by giving them a point of accountability and a point of coordination for all their financial activities. Mike, if we could move to the next slide. So who are our clients? Our clients are entrepreneurs, business owners, professionals, attorneys, doctors, business executives, multi-generational families where there's a need to be purposeful and thoughtful about multi-generational estate planning and family governance, charitably inclined families that have wealth and want to be able to make philanthropy a part of their legacy, high net worth individuals planning for retirement or actively in retirement. These are just some examples of the high net worth and ultra high net worth individuals that we work with, collaborate with every day to bring value. So with that context on Wealthspire, I'd like to turn things over to my colleague, Mike Delgass, who, as I mentioned, is a talented financial advisor. He also runs our Northeast region. He works closely with numerous ultra high net worth and high net worth families. Mike, I'll turn it over to you to discuss the current financial landscape, some of the criteria that clients should be considering, unique to today's environment, and some of the strategies that we've been able to deploy in assisting clients. So Mike, over to you.
Thanks very much, Mike. Appreciate it. As Mike LaMena mentioned, I'm going to be talking a little bit about the current environment. This says election impact, but it's not just the election. It's everything going on in the current financial world, a lot of which is impacted by the political governance structures and things that are going on. The COVID world combined with the political issues bring us a lot of potential change. On the income tax side, we went from a concern that maybe capital gains rates were going to double to an expectation that that probably won't happen, at least not right away. We'll talk more about that, and we'll have some other people come in and talk more about the political landscape. So I'm going to leave this aside. I will say that this is something we really focus on, both in terms of the way we manage portfolios, but also the way we help families construct asset ownership and trying to maximize deductibility of a variety of expenses and fees and that kind of thing. There were also a lot of potential estate tax changes that could have happened as a result of this most recent election. It appears right now that there's a low probability that the Democrats will take both Georgia Senate seats, which means that we're going to have a divided government. That probably means that we don't see far-reaching estate tax changes, although there are a lot of things that are going to expire of their own weight because that's the way the statutes were written in the first place at the end of 2025. So we're working very hard on getting some pretty significant planning structures in place for clients. This is something that really requires a lot of focus, but it's probably not a before the end of the year, before the end of 2020 kind of thing anymore, because there was quite a flurry of activity focused here for a while. Instead, we're going to focus on some other follow-on effects of the pandemic and some of the political climate, and that's interest rates and financial planning generally. As Mike said, financial planning is really the core of what we do, and that can be ensuring that people have enough, that retirees ensure that they don't outlive their money, or it can be ensuring that distribution rates from trusts are adequate to provide for second and third and fourth, and we have 5-generation families. So it's very wide ranging, the kind of modeling we do to support that kind of financial planning. But a lot of what interest rates impact is obviously in the fixed income world. So I'd like to talk a little bit about how that on the very practical level hits our clients and makes some of that modeling even more important, sometimes even more difficult, but even more important for sure. So, as Mike LaMena was saying, really what we're trying to do for people is give them peace of mind. We're trying to help them meet goals and handle the things that are really concerning them. And people like business owners who are in the middle of sales, and believe it or not, there have been some quite large transactions that have closed in the middle of the pandemic, whether it's people who retired in the middle of the pandemic voluntarily or involuntarily. A lot of these clients are looking to replace compensation. And obviously, the where will my money come from now is a huge source of potential anxiety and anxiety we're trying to remove for people. So this is a really, really important question. But as we go into a very low interest rate world, it's really not enough to just kind of think about an old school strategy of, well, what are the coupon rates on bonds? What can that kick off? And is that going to be enough to meet inflation and my needs? That you really have to get more sophisticated than that. Because right now, intermediate bonds are yielding a little less than 1%. The 10-year right now is about 92 basis points, or 0.92%. And obviously that's fluctuating day by day, but it's, it's been even lower than that. And inflation projections are double that, basically, or more, depending on the period you're looking at, kind of thing. So you have to get beyond just yield and clipping coupons. You have to think a bit more broadly than that, which was always good thinking, right? Having an undiversified portfolio of simply bonds was never a great idea, probably, especially if you're trying to outpace inflation. But really, it is very challenging to try to solve all of your financial planning needs simply with yield, whether that's yield from bonds or yield from stocks, because generally yields across the board are pretty low. Okay, so there we go. Sorry. So yields right now, they're impacting the bond world clearly, and let's look at how that impacts bonds specifically. So first off, there's a lot of math behind bonds, and it can be intimidating. I don't think it has to be. So this is a chart that looks a little confusing maybe from the beginning or from at first glance, but here at this, this tail line here, you can see where the yield to worst is, which is basically the yield you should expect. And you can see it's around 1%. This is for the Barclays Ag, which is basically the taxable bond index. And you can see that line trending down, over history here to present day. And you can see duration, which is a measure of interest rate risk, going up. And trying to, help people conceptualize this, basically think of it like this. If you have a 30-year bond, that feels like it's going to be a long time before you see your money. Just to keep the numbers easy, let's say you bought a 30-year bond for $100. But let's say the coupon was crazy high, very, very high. Interest rates were super high, and you got 100% coupon. Well, in a year or so, you'd have your money back. You'd have all of your $100 back because it's paying you $100 a year, which is a great interest rate, obviously one we've never seen before. But the duration, the risk of that bond of, to changing interest rates has got to be really low because you're getting all your money back right away. Compare that to a rate of 0%, where you don't get any interest and you just have to wait for 30 years until that bond matures, and then you get your $100 back. That's a very different kind of risk because you're waiting, and interest rates are going up all over the place. And you may be really missing out, right? Because the 0% interest rate doesn't look great if everybody else is getting 5 or 10%. So what that means is basically, as interest rates go down, duration goes up, right? Because remember, if that coupon is really low, you're waiting for longer and longer before you get your money back. And that means your interest rate is higher. So this line here trends up as this line trends down. This duration means that there's more interest rate risk to fixed income than there used to be, and there's less yield than there used to be. Now, it's important to distinguish yield from total return. Yield is just the cash you get, right? It's just, what am I getting on my bonds in cash right now? Bonds usually pay twice a year, so every 6 months or so, you're going to get a check. Not really. I mean, it's going to be deposited in your account, but it used to be like that. So that's your yield. That's kind of coming in your door and is spendable cash for you. But your total return can be wildly different. And right now, bonds have done okay as people have fled to them in the face of equity market volatility, right? So the flight to quality at the beginning of the year meant that bonds went up in price, even though interest rates were kind of low. Because people weren't looking for return on their capital. The saying is they're looking for return of their capital, right? They're looking to be protected, and bonds give you that kind of protection. And so total return can be better than yield sometimes. And sometimes it's a lot better, right? There have been times when we've had double-digit total return for bonds, on a temporary basis, even though the yields have been relatively low. But unfortunately, that doesn't really help us out that much right now, because it turns out that the starting yield is a very important predictor of where total return is going to be for bonds down the road. And let me tell you a story. Let me show you a chart here that explains that. So this blue line is starting yield for bonds, okay? And the gold is a rolling 10-year return for those intermediate bonds. And so let me explain what that means. In 1953, we started with about a 3% yield on intermediate government bonds. Okay, so that's our blue line. We put that point there, and that's our first blue dot. And then we look at the next 10 years to 1963. And we say, okay, what was the annualized return, not just yield, but return for bonds? And we plot that in gold. And when we do that, and we make that calculation, and we go over here and we plot that in gold, we find, oh, look, it's right on top of that blue line. It is the same, it's 3%. That was what you got over the next 10 years, 3% every year in terms of return from 1953 to 1963, right? And then we plot this out. And what's interesting is you can see that there's very little daylight here between the gold and the blue. That is, in English, starting yields are very good predictors. And in fact, it turns out they're the best predictor of what bond returns will be over the, say, intermediate term, the next 10 years or so. And of course, here's the problem, right? Is right now that starting yield is 1%. And so best guess for the next 10 years, 1% total return for bonds. It's hard to get excited about that. So hang on a second. Let's put the brakes on this. Does that mean that you should own no bonds at all? I mean, are bonds kind of passe now? They're kind of too old school to be interesting? Well, not really, because there's a certain amount of negative correlation. There's, bonds tend to zig as stocks zag. And so, for example, that first quarter sell-off that Mike LaMena was talking about, taxable bonds actually went up. Intermediate governments, great. They were very good performers in the first quarter as the equity market, the S&P 500 went from positive 5% in February to negative 30% in March, right? So bonds actually helped cushion that, right? So they dampen volatility. They're very important asset class for that aspect. But it's important to get the ratio right. So before we talk about that, though, let's look at what that actually means in history and in practice. What does that volatility look like? So remember, keep in your mind negative 30%. So in the space of a few weeks, the stock market went from, kind of mid-single digits to negative 30%. Let's look at how that compares to bond market volatility. So we go along here and we look for negative returns at all. It's actually hard to find them, right? Negative 2%, negative 1%. There just aren't very many here. Negative 3% is actually kind of the bond market crash. Like, this is the jump out the window, oh my God, the sky is falling kind of number for the bond market. This is what bond market volatility looks like. Most of the time, you see positive numbers. Not always ones that are great compared to the stock market, right? But it's fairly rare that you see on an annualized basis a negative return for bonds. Doesn't mean it can't happen, And it's more likely to happen a little bit when interest rates are low and moving very rapidly, which is basically what happened over here, very rapid interest rate moves. But big negative numbers, you just don't see them on the same level as you see them in the stock market. Stock market volatility is totally different than bond market volatility. So when we're designing portfolios, and by the way, those aren't the only asset classes we're looking at, but just kind of keep it simple here for a second. It's important to have the right kind of allocation and the right kind of modeling around those numbers. So from a financial planning standpoint, we've got to have the right capital market assumptions. And that's one of the things that we do, is we create a capital market assumptions. We create a plan that has predicted returns for stocks and bonds. And we do that in a way that is not just us. We average out a whole bunch of other people that we respect, including the Federal Reserve and other big banks and that kind of stuff. Because look, nobody's the smartest person in the room on every given day. So we average those out across a whole bunch of predictions we think are have been pretty accurate in the past. And we put those into a financial planning model that we use to test allocation and spending, to get a really personalized view out of those general market assumptions, because now we get to the individualized client level issues where clients have a certain amount of money, certain amount of resources, and a certain amount of needs and goals, draws on those resources with different timing around those goals. I need money now, I need money in 10 years, that kind of thing. And so we have to think about the way that impacts their overall financial plan, which relates back to the allocation, right? Because the overall average return and average volatility for the portfolio is going to be controlled not just by the spending, it's also going to be controlled by the allocation. And spending matters a lot there too, because if you're needing a lot of money at very particular times and very rapidly, then you've got to have less volatility potentially, because if the market is down a ton and you need the money anyway, you've got to worry about that. So let's look at a quick example and then I'll turn this back over. But just so you see how we approach things, let's use a $25 million example just because the numbers are kind of easy to work with. That doesn't mean that's all, we only work with $25 million clients. We work with 1 million, 5 million, 25 million, $250 million clients. Is a very broad platform, right? But just to keep the numbers easy, and because this was an actual real example, we looked at a $25 million client, that is, they're realizing $25 million from the sale of their business after taxes, and they want to spend about $1 million. But they are thinking that maybe they want to spend a little bit more in the beginning, right? So we looked at another possibility here where they have a front-loaded spending and then they reduce things on in the future. And I'm not going to get into all of the details here. I'm just giving you an example of how it is important to think about stress testing and modeling portfolios, because after we just lived through a 30% drawdown in the market, one of the things that we're doing for clients right now is pretending it happens all over again. Because notwithstanding the fact that, hey, we might have a vaccine. I mean, I think we do have a couple options for vaccines here, but we could have bumps along the way in terms of how those are rolled out and, efficacy and that kind of thing. So let's plan for that. Let's plan for a bad timing scenario where this business owner who's just sold his business has to live through a whole nother round of 30% drawdown without an immediate recovery. So worse than this year, actually. And down here, you can see the way that stress test looks, where in 2020, we're assuming that we just fall off a cliff basically the rest of December, and the portfolio is down about half the market, because the allocation here is about a 50%, it's about a 55% equity allocation. And then in 2021, we still don't get a recovery. And actually, we have a modestly negative year. If you put these together, this feels around like an '08 kind of 50% drawdown in equities. And when we look at this on behalf of clients, we also do this kind of Monte Carlo analysis, which when I was a science undergrad, we used to call multiply iterative stochastic analysis, and now we just call it Monte Carlo analysis because it's like creating a roulette wheel for a client that looks like them. That is, it tracks their volatility of their portfolio, the way they're allocating, the way they're spending impacts that volatility, the expected returns that we put in for them, and then we spin it over and over, and we get all of these potential scenarios with different probabilities around them, but we stress test to, what if there's another shoe to drop that's in red? There's a big dip here, but look, things turn out okay. We still end up with plenty of money at the end of the day. We look at average returns, but fundamentally what we're doing is looking at a more probabilistic way of thinking about portfolios that actually turns out to be more accurate. That is, the world is a probabilistic one. It's one where you can't be absolutely certain about really much of anything. But if you're careful about the way you're doing predictions and you really bring some rigor to planning, you can get to something that feels like certainty and something that feels like comfort for clients, which is really the business we're in. So with that, I will turn this back over to Mike, and thank you very much for the time.
Hey, Mike. So let me say thank you to both Mike and Mike. We do have a question that came in, Mike Delgass, and so I'll pose it to both you and Mike LaMena. How does the weakening dollar impact the future of these discussions? So you gave lots of client examples and lots of views on how you move a client in and out of a different asset class. So how does the weakening dollar play into that?
So in the first place, you have to look at your actual client. And we have non-dollar clients, that is people who are not just spending in US dollars. And there, obviously, currency risk is hugely important to them. And we've got to figure out ways of doing simple hedges. That is, making sure that not all of their cash is in US dollars, and they have things that are in native currencies and other currencies that they may need to work with. We've got clients that kind of are Caribbean, Europe, US, and now we have to worry about many different potential currencies. And then there's Brexit and everything else they have to worry about. But it also impacts investments because currency risk impacts international returns very much too, because a weakening dollar can help, and maybe that implies you want more international investments. So that would be one way, even for US dollar-based people, you might want to hedge and change the way your allocation looks. But look, if you're US dollar-based and really that's all you're doing, the weakening dollar has less impact on you as long as you're not kind of overextended on international investments and that kind of thing. I mean, it can help you if you have a fairly hefty kind of international slug, but look, that can go the other way too. And if we're starting from a fairly weak dollar, I think you have to worry that that worm turns eventually. And so currency volatility is something we focus on a lot when we're considering international investments.
Great. One more question for you, Mike. Where do you think the capital gains tax rates are going in the next year or two? And we'll probably get that opined in the next segment too, as Armstrong comes on. But
yeah, I think Army and Kristin are better equipped to answer that than I am. And we do have that teed up. However, I mean, look, my crystal ball gets a little cloudy when I peer into the smoke-filled rooms of politicians. I gotta believe that states are going to need to increase their rates a little bit because the feds have been slow to give stimulus to state governments. So I would expect the effective capital gain rates for people to go up marginally. I don't think they're going to double, but I'm going to shut up now because I'm probably not the guy to answer it.
All right. Well, look, that's probably a great segue to our next segment. But Mike, I just want to say thank you. You guys are great leaders. You're part of a wealth management leadership group that is second to none. And I'd be remiss if I didn't just say, thank you for the way that you lead us, the way that you lead clients. And thank you for participating thus far on the call. I want you to hang on because the next segment, I'm sure we'll have questions, and there may be a chance before we wrap to bring you guys back on. But thank you very much for that segment.
Great, thanks for the opportunity.
Okay. All right. So now let's move to the next segment. Kristin Bulat and Armstrong Robinson. What's interesting about these two is they've developed this podcast rapport where they go back and forth on a regular basis. So if you haven't picked up on any of that, you really should. But for those of you in the NFP internal world, Kristin Bulat, she's a thought leader for us. She brings the advanced strategies to light and helps all of our firms realize solutions that take place in the field. And then Armstrong Robinson, who's Chief Advocacy Officer at Finseca. I have the pleasure of sitting on the board at Finseca and has had a long history of advocacy in Washington. I consider this a true inside perspective to have Army on this call. So hopefully every client and all leaders and advisors that are on the call today will see this as a valuable segment. So without further ado, I'd like to turn it over to Kristin and Army.
Thanks, MJ. It's a pleasure to be here today. And Army, thanks so much for joining me on this conversation. We just had the opportunity to hear Mike and Mike with Wealthspire give us their insights into the economy and what sort of headwinds we may be facing as we help our clients with their financial plans. And so, Army, I thought it would make sense for us to start by talking about the economic reality that the incoming administration is facing. Caitlin, if you want to advance to the next slide.
Thanks, Kristin. Thanks, MJ. I'm tremendously honored to be with you all today. Happy and safe holidays to everybody. In direct response to your question, you've heard a lot about the K-shaped recovery that we're going through. I think this chart that's in front of you, which shows the impact of the last 4 major recessions by earning quadrant. And so you can see 90, 01, and 08, like they all track, they're affected differently, but they all track sort of similarly. And then you see the coronavirus crisis, where the highest earning 25% is already back to even or better than even, and everybody below that is still down substantially. And for those of you who've seen any of my presentations over the last couple of years, one of the most important themes for clients and advisors in this space is the rising populist trend in both the Republican and Democratic parties. And this contributes substantially to that. The things that Mike and Mike were talking about as things we were worried about pre-election coming to pass, in terms of taxing wealth-like wages, doubled capital gains rates, taxing capital gains at death, and a whole series of other ideas, the wealth tax proposals, are all sort of born of this reality. And it's not just a Democratic phenomenon. There's a lot of the Republican Party's base that is not sort of the country club high earner anymore. And so it's a key trend we have to watch on both sides, Kristin. Absolutely,
thank you. And when you and I spoke a little bit earlier this year, we talked about the 3 big recessions that you're showing here and how the federal government has had to step in and sort of bail out taxpayers and individuals. And each time they have to do it, it's more and more expensive. And I think in light of the sort of stimulus packages we saw pass at the start of this year and the current conversation, and we talk a little bit about the stimulus bill that is circling Congress right now and sort of how that is really sort of driven by a lot of these market factors you're talking about.
Absolutely. And it's, as we talk about the bubbles we all live in, it can be very difficult to see how the other half lives today, particularly while we're in some form of quarantine, stay at home. There is a lot of people in pretty dire straits, and Congress has sort of procrastinated its way to the end of the year. Their final deadline is always the Friday before Christmas. So this week they will pass a 1-week stopgap to take them from the 11th to the 18th. And they're currently in heavy and heated negotiations. I've been multitasking this morning because we've got some things we're working on all of your all's behalf that we're trying to get done in that process as well. I can't predict exactly what the outcome will be yet, but I believe it's a question of if not, or when, not if, the next round of COVID relief comes. Whether it comes in part before Christmas and in part in February, March timeframe, or all in the February, March timeframe, I believe we will get another economic stimulus.
And in addition to the economic factors that the incoming administration is facing, we also really don't know yet what the makeup of the Senate's going to look like because of the runoff that's happening in Georgia. Can you give us a little bit of historical context for that runoff before we talk about, speculate on what it could mean for the administration's priorities?
For sure. So we've got both Georgia Senate seats up at the same time. In U.S. history, we've had both Senate seats in a single state up together on an election 55 times. And in only 8 of those was there a split decision returned by the voters. In the others, and this is historically precedent, and I think what is likely this year, you're more likely to get both Republicans or both Democrats. And so where we sit today is Republicans have 50 seats in the Senate and Democrats have 48. So the best Democrats can do is 50-50. And if one or both go to the Republicans, then Mitch McConnell is majority leader for the next 2 years.
And if Mitch McConnell stays majority leader for the next 2 years, let's sort of game out what the Biden administration's priorities are going to be, what their sort of first 100 days as they hit the ground running are likely to be in a context where Mitch McConnell is running the Senate.
Well, I think the President-elect Biden is likely to have largely the same priorities. It's just a question of what the aperture and ambition around those priorities are. Just like the man he served as vice president, Barack Obama, he's going to come in and the COVID health and economic impacts will still be quite acute by his inauguration on January 20th and through those first 100 days. So just like the economic recession of 08-09 that Barack Obama faced coming in, I think the first major goal, sort of no matter who is there, is what else needs to be done from a Washington, D.C. perspective, legislatively and executive action around COVID for healthcare and the economy. The other big things are going to be focused, I think, around climate change. He said he'll rejoin the Paris Accords on day one. Immigration is a big one. There's lots of dissatisfaction amongst Democrats about how, and many Republicans too, about how Donald Trump has handled the immigration issue. So that will be a key thing. And those two things, as well as his international activity, all relate to things he can do by executive authority without needing affirmative actions by Congress. And that, of course, is where I think he will focus first.
One of the questions that I've been getting a lot is around tax reform. And we even got that question earlier in this very webinar, what are capital gains rates likely to be? And you and I talked earlier this year about all of the Biden tax proposals. And it's a question, I think, it's a two-pronged question, really, which is, if we have Mitch McConnell still running the Senate, what tax reform is likely to be possible? And then the other question is really, when would we see that reform? And I know I'm asking you to speculate, and I promise we won't hold you to it, but what are you hearing in Washington and sort of reading the tea leaves? Where do you think we may end up?
Well, Kristin, as you know, at Finseca, on all of your behalfs, we plan like you do for the long term, just like Mike and Mike discussed. Like, we don't need to just win next year or next quarter. We got to win in 21 and 23 and 25. So, beginning with the end first, because of the way the Tax Cuts and Jobs Act was written in 2017, with about half of it being on an expiration date of 12/31/2025. By then, if not before, we will see a major tax bill be written in Congress, written and enacted in Congress, because just like the 2010 to 2013 period, Congress will want to protect their constituents, particularly the middle income and lower income folks that they like to talk about, from substantial tax increase cliffs. Backing up, I think, even if, so as I said, even if Chuck Schumer becomes majority leader by virtue of the Democrats winning both Georgia seats, they will still be at 50-50, which basically means that Vice President-elect Kamala Harris will have to become a semi-permanent feature of the Senate again, which she has just left, because in that environment, she's the tiebreaker, and they have to keep absolute perfection of intent to get anything done. They have to keep all of their votes. And that fact will still serve as somewhat of a moderator. But if you get that result, certainly there's a lot of interest amongst Democratic and progressive voices to tackle the wealth like wages stuff. So there's more opportunities there. But I think that even in that scenario, Kristin, it's back half of next year, because we need the economy to come back. We need the COVID vaccines to be deployed before even, I think, progressives and Democrats are likely to start raising or adjusting a lot of taxes and expectations. So it's probably at the earliest last 6 months of next year. But, again, we plan for the long term. So we're already looking at the 2022 Senate map, and it's a very difficult road for Republicans. So even if Leader McConnell stays majority leader for the next 2 years, it's possible that Joe Biden could end his first term with all Democratic lineup, and we would be facing some of these same proposals that you and I have talked so much about, Kristin.
That would be interesting timing too, because it would be right around the time that a lot of the provisions of the Tax Cut and Jobs Act from 2017 would be sunsetting. So it would, I think, could be really interesting for us. We'll probably be doing a lot more of these webinars and podcasts as we get closer, and that reality of tax reform becomes much more realistic. Before we transition to what sort of planning we think other people should be doing, can we just talk a little bit about where you see the international priorities of the new administration? We started this series with Admiral Stavridis and his vast experience on the global stage, and you mentioned the Paris Climate Accord. Are there other things that we should be looking for in terms of a Biden administration sort of priority as we transition into the new year?
Anytime you're mentioning my name in the same stratosphere with Admiral Stavridis, you've raised the game for me. I think what I expect, though, is that I expect Joe Biden to focus a lot on wanting to restore America's place in the world. You think about the American hegemony that has occurred from the 50s through today. And, really Donald Trump's international policy was to recede and be very insular, America first focused. And I think Joe Biden sees it differently. He'll want to sort of restore America's lead. And so I think China is a major priority. The Chinese are affirmatively trying to replace the United States with that role in the world. And we saw this, the TPP trade agreement that the United States was negotiating at the end of the Obama administration, Donald Trump removed us from. And just recently, the Chinese did a Pacific trade deal. And, the original concept of the TPP was the US and a whole bunch of South Asian countries as sort of a counterweight to China. And now the US is out and China's in, doing an alternative deal that we're out of. And so I think there's a lot of work around that. Immigration, we've talked about China and the role in the world, climate change. Those are probably the biggest things right away.
Thank you. And now I'd like to sort of transition to what you're saying to your clients and what we at NFP are saying to our clients in light of all of this uncertainty. Mike with Wealthspire talked about the Monte Carlo simulations and sort of the long-term planning that they do for their clients to weather volatility. at Finseca, your real focus is on financial security and stability. So what are the things that you anticipate talking to your advisors and their clients about in the upcoming year and going forward?
Well, we're constantly doing education and re-education because there's so much turnover at the member and staff level in Congress. And most of them are not, by background, financial security experts. So that'll be a lot of our focus going forward, teaching the value of products and planning, the likes of which Mike and you and MJ deploy into the marketplace. And that's where our name comes from. We're inspired by the calling of your profession. And for the clients here, the NFP team is there trying to deliver on your financial security every day. And that's where Finseca comes from, financial security for all. So we'll be doing a lot of education work around that. And because of the potential for an all Democratic control of Washington in after the 22 election, we've got to do a lot of education around the implications of doubled capital gains rates, is one of those things, right? Well, you double capital gains rates to take them to 39.6 or 40, and you tax capital gains at death or repeal step up in basis at death, and you keep or raise the estate tax, and you can get a cumulative tax hit that's in the 70s very quickly. And so, they tend to, in politics, talk about these as singular proposals because of revenue or politics and responsiveness, but we have a responsibility at Finseca, as you do as advisors and clients, to deal with the totality of these things and how they impact people. And so we try to do a lot of education and work around that, and we will certainly be focused on that. The other thing we haven't mentioned yet today that I was remiss to not include is one of the major opportunities for bipartisanship next year, Kristin, is in the retirement and security space, right? You talked about, the CARES Act in March was a $2.7 trillion liquidity injection into the American economy, the American public, small businesses, which was necessary because too many Americans are underplanned and undersaved. They haven't done the kind of long-term planning and saving that Mike talked about. And so we think it's appropriate at Finseca that when you're facing this is the third such crisis we've had in the last 20 years, to invest more in incentives for saving and planning and tools like long-term care, life insurance, hybrid products, et cetera, because we want to prepare people better to take care of themselves, because the next crisis, I don't know what will cause it, but we will have another one.
Yes, thank you. And, in our last few minutes, I just wanted to talk about one of the things that we do with NFP is we really look for strategies that work for clients. When I'm on the life insurance side, when you're doing life insurance, you talk about life expectancy of the client, how long that client is likely to live. Mike, their Monte Carlo, how long are you likely to live? How long will your money last? One of the things we also need to think about is, what is your political life expectancy? How many administration changes are you going to live through where each one wants to put their stamp on tax policy or economic policy or any one of a number of things that will dramatically impact an individual's planning? And so we talk about, let's do flexible planning. Let's do long-term planning that allows you to react in a positive way. You can be proactive and not reactive. We talk about how life insurance and proper planning can help insulate you from estate taxes, but also income taxes, and really buttress the other pieces of your financial plan. So, we're looking at helping the individual and helping their businesses really take advantage of what's here today so that they can plan for tomorrow. That's the beauty of working with NFP, with Finseca, and having such a broad reach in the industry. So thank you for your insight today, Army. I'm going to toss it back over to Mike James.
Thank you, Kristin. Thank you, Army. You two have become just such a great act together. So we're looking forward to hearing more from you. And we are just 1 minute from the top of the hour. And we did get a couple questions in. Whatever we don't answer on this call, we'll get out to the folks who are asking those questions. But all three sessions were recorded, from Admiral Stavridis to our compliance and property and casualty and benefits division to now wealth management and life insurance. All three call segments are recorded and will be redistributed to all participants across the company. So for those of you that missed any part of it, you'll get a chance to witness it on your own time. So I just want to say thank you to Mike and Mike, both you, Kristin and Army, for helping us deliver what I think was a really informative session to clients, leaders, advisors from across the world at NFP. So thank you for your time today, and this concludes our call.